Greg, welcome to the podcast, and thanks so much for joining us today. I appreciate you making the time.
Yeah, Jeff, happy to be here.
I've really been looking forward to this conversation, given how much time and energy we've spent thinking about credit data, credit modeling, and I got a number of things I think we want to cover. But I wanted to start off with just asking you, what are the recent trends you're seeing in the way people are approaching the question of leveraging credit data for the underwriting of credit risk? It feels like kind of an interesting time in that space to me. And then I also later want to kind of dive into alternative data and some of the newer things. But just at a high level, what are the big trends you're seeing?
Yeah, well, I think this is a really great opportunity, just given where we are in the market, the kind of the craziness we had through the pandemic with the economy. It really has shown, I think, where credit has worked and also where maybe there's opportunity. And at Experian, we want to be the consumer's bureau, and so we're really serious about addressing the opportunity around financial inclusion. And I think exactly what you're talking about, how we score, what data we use, the analytics we're applying, definitely opens up doors that we've never had before around how we can drive financial inclusion for everyone in the U.S. economy. And so I'm excited about talking about a lot of different ways and a lot of different approaches to help drive that.
So what are you seeing people do? I think the financial inclusion angle is really interesting because, our perspective, and I think you share this, is that more sophisticated techniques, more data can actually increase the world that we can lend to, whether that's through scoring unscorable or better understanding risk to approve people who were unapprovable previously. What are the trends you're seeing? And I'm kind of curious, it seems to me like some of these capabilities have been around for a while, but be they trended data or, much more data in the credit file than just like a credit score, one score or another score that lenders have tried to rely on. So, what are you seeing people do differently? And why do you think this wasn't done somewhat earlier? What held people back from moving towards a more sophisticated approach to underwriting than maybe is being leveraged today?
Yeah, well, I think that's a great question. Let me maybe take a step back and look, who is in the lending market today is very different than who was in the lending market, say, 5 years ago, 10 years ago. And I think a lot of that is what's driving the change as well. So you think about traditional large financial institutions, they have the scoring models they can have fairly sophisticated analytics, but at the end of the day, they're very comfortable using conventional credit scores in their models, as well as a lot of other attributes. Then you look at credit unions and regional banks, again, less sophistication in their credit models, less sophistication in the analytics, and even more reliance on conventional credit scores. And then you have new entrants, whether it's fintech from a few years ago or now even buy now, pay later players or large tech players like Apple or Amazon who's coming in and looking at lending in a very different way. And I think pushing the market in good ways of us thinking about how we leverage scores, different analytics, different approaches. And so a factor of different lenders coming in and looking at it all fresh, where sometimes even thinking about credit as like, that's the old way of doing it, let's think about the new way of doing it. And I think that's really refreshing. And as Experian, we are always looking forward to how we can help drive financial inclusion with a lot of different types of data sources. If you look at, let's just make the case, why? If you look at conventional credit scores today, they can score about 82% of the US population. A bunch of that is because people are credit invisible. They don't have a credit report in the bureau today. Some of them also have a credit report but are unscorable. So they may have a thin file, which means they only have 1 or 2 trade lines, maybe 3 at max in their credit report, or they have a stale history. They're not active with their credit trade lines, their credit vehicles today. And so the conventional scores are just, they don't have enough data to score them. Now, I think some progress has been made. The credit bureaus working with lenders and working with a company called Vantage came out with a new score. It looked at the traditional credit history that you would have on your credit report. It also looked at what you already talked about briefly, trended data, which is how you behave with your credit data over time and how you maybe are changing your utilization. Maybe you're leveraging up or leveraging down, or the type of average balances you have over time. And that can give more information about who you are as a consumer and your ability to take on more credit responsibly. And they also applied some advanced analytics, so AI and machine learning techniques to build that Vantage score model, especially when they went to Vantage 4. Now that took the scorable population of 82% on conventional scores up to 89% for the US population. Big improvement, but frankly not good enough. And when you start looking into Black communities, marginalized communities, Latinx, brown communities, those scores go down. Like the scorable populations reduce. And I think we're at a point in time when that's just unacceptable. Like we have to do a better job. We have to, as a credit bureau, working with our lenders and looking at how we serve our communities, driving financial inclusion for all types of credit products into those marginalized communities as well, to be able to say yes to more people in a responsible way that does not create more risk is something you can do right now. It's not something that is in the future, something we can do someday in the future. I think we can do it right now, and we should be doing it. We've seen how you can improve upon conventional scores moving into Vantage, and we've even gone beyond Vantage into a new product we just launched called Experian Lift. I'm not really here for a product pitch, but what's important about Lift is we can now score 96% of the U.S. population. So there's just a small slice.
Close the gap? Where's I know Lyft, and you've got a product Boost, I think as well. And again, we don't have to get into products, but I think, what is the core of what those things are doing or providing, or how are they augmenting the scorable population? I mean, like, just help people understand like what's driving that improvement in scorability.
Great question, and maybe I'll take them in turn. There's really three different things that I think is the future of how we drive more financial inclusion, more scorability, and frankly, just showing the full picture of a consumer's financial profile and their financial potential. So first of all, and you mentioned Experian Boost, this is a unique product we launched on Experian.com where for free you can go and you can add your bank statement read-only data, and we will then pull in off of that your positive bill payment history. So paying your utilities, your water bill, your electric bill, even things like your internet and your cell phone, and even as far as your streaming services. All of those we identify, we show it back to the consumer. They verify, yeah, that's my water bill, that's my mobile cell phone bill. We show them the data. They add it directly to their consumer credit report. Instantly we rescore it and show it back to them on their mobile phone and says, hey, here's your improvement in your FICO score because you've permissioned more data to your credit report directly. I think the consumer permission model is a way for consumers to engage directly in their credit history, add more positive data. A lot of consumers think, hey, what do you mean my water bill and electric bill and cell phone bill aren't on my credit report? I'm paying what I owe. That should be reflected. And a lot of people think it already is reflected. And the reality is, in the most part, it's not. And when it is, it's usually because you failed to pay and we got a negative collections notice. And that's what shows up on your credit report. This is a way for consumers to engage directly with their credit report, add their data instantly to their credit report, and get the credit for paying their bills on time. I think that's a no-brainer and just something we should be doing de facto going forward. If you go to Experian.com right now, you can go do it in a couple minutes. But that's been able to allow, I think now over 10 million consumers add additional data to their credit report, and we've boosted FICO scores by over 50 million points in aggregate. That just shows the extent to which you can actually, as a individual, have an impact on your own credit report and your own credit score, which has always been the promise of something like going and doing credit education and engaging with your credit score, and eventually if you do the right things it'll go up. Well, this is something you can do right now that will instantly impact your score most of the time.
It's huge for lenders that you're doing this as a CRA, because I mean it's something a lender can do, but the technical integrations, the reading of the data, and then of course if I'm using that data to credit decision, my sources of data need to be CRA. So either I have to get it from the users, or I have to find some CRA source that will provide it. So you guys, my understanding in this context, are kind of serving as that CRA filter, so I can get at least the impacts of that data on a credit score through Experian and not have to deal with the CRA implications, like trying to figure out how to deal with utility companies and phone bill companies and services.
And even better, because it goes directly on your credit report, and the existing scores in the market, whether it's conventional scores like FICO or it's Vantage or other, they automatically accept that data. So you instantly get that appreciation of your positive bill payment history. But the best part is you're still the consumer. You're in the driver's seat. This is your data. You permissioned it to your credit report. At any time, you can take it off. You can disconnect your bank account. You can decide not to continue to furnish certain trade lines or bill payment history. You're in the driver's seat. They're completely in control, which is great. The two other areas that are less around direct consumer engagement, but ways that as a credit bureau, as also working with our financial institutions and clients, we can do a lot more to drive financial inclusion. The second category of that is really looking at extended FCRA data. So FCRA is the umbrella in which we all operate to do credit decisioning. we have to have data sources that are approved and can abide by the displayable, disputable. We can show it and clearly demonstrate to the consumer where the data came from, and they can tell if we got it wrong, and they can go through the process. So that's all under the FCRA guidelines, but using more data that goes beyond the core traditional credit report. We already mentioned trended data as being one of the ways to use data that has not traditionally been used for credit scoring, but we can go a lot further than that, and that's where something like Experian Lift comes in. We bought a specialty credit bureau called Clarity Services, which is in the alternative financial services space. Think payday lending, rent to own, short-term installment loans. We combined our traditional financial credit bureau with trended data plus Clarity plus a positive public records data source from LexisNexis called RiskView 5.0. We combined all of those together, and by doing that, again, that's where we went from not just 82% scorable or with Vantage 89% scorable, but all the way up to 96% scorable. So now we can score basically any credit active inbound inquiry a lender might have. But on top of that, it's more predictive because we're using a broader data set. Not only can you say yes to more people, but you're actually not taking on more risk. And so we work with clients, and they can actually dial back. Do you want to say yes more? Do you want to take on slightly more risk or slightly less risk? And you can actually dial that in any way that you want to do that while driving financial inclusion and taking on less risk for your portfolio. But what really makes all that work is the third category, which is advanced analytics, applying AI and machine learning models and techniques to how you build a credit score and attributes across multiple data sources. It'd be much harder to leverage 3, 4, 5, 6, 7 data sources if you weren't also applying these advanced analytical techniques, which is how we built Experian Lift. And it's also how we built the kind of what we call explainable AI. It's taking the model to its optimum threshold and then dialing it back so we can actually have explainable not disparate impact, but adverse actions, and having the codes that all work so that we can all have it behave like a normal credit score with adverse actions and then have it fall under FCRA. And again, I think 5 years ago, it was kind of scary to talk about using alternative data sources and using AI and ML. But I think today this has become kind of standard course. And if you're not doing it, you're missing out, and you're actually leaving both money on the table and you're choosing not to serve communities that you could be serving right now. So I think those are the kind of three categories: consumer permission data, extended FCRA going beyond the traditional credit report, and then leveraging advanced analytics to use all of that.
Well, you can't. I mean, I can only imagine what the scorecard would look like if you were using a traditional approach with all those data sources. You have a very large table with a lot of dimensions. But
That's right.
I want to ask your take. I mean, you mentioned that if you're not, you're leaving money on the table if you're not doing this today, and I think it's actually worse than that, because you're increasingly being not only leaving money on the table, but what's left for you is being adversely selected by people who are out there doing this and finding in any given credit, in any given score population that one lender might see the people who are better than that from a credit risk point of view, and they're making better offers. And so I think the lenders who don't do this will actually see a deterioration in their performance because they're going to start to be adversely selected by smarter lenders. But I'm curious, the point I dispute is I don't think it's all that common, at least among the financial institutions I talk to. They're aware of it, but whether this is really in production at scale at most FIs, I question. And I think the big reason is a lot of concern or uncertainty around the regulatory environment, and nobody's gotten in trouble for these things. At the same time, they haven't been around for 50 years with nobody having been in trouble. So there's this question of are the regulators going to be okay? Are they going to come after this after they go after big tech for their ranking algorithms and whatever else? How do I get comfortable that regulators are going to be okay with these approaches? So I'm curious your perspective on that, because I know you have a lot of engagement with the regulators as we do on this topic. I'd love your perspective on where you think they're at and what you see coming in this space. I'm not sure it's so much that people have heard negative things from the regulators. They haven't heard the positive things either necessarily. And so that lack of clarity, I think, often for financial institutions just means, hey, let's wait until there's a more clear answer coming out of my regulatory body.
Yeah, and maybe let me take a couple angles on that one, because I think it's a really critical topic. From the consumer permission data angle, I think we've heard nothing but positive from the CFPB and other regulators saying you should be doing this. And when you look at when you talk about alternative data, they've also talked about you should be leveraging utility data and rental data and other positive bill payment history that doesn't make it to the credit report today. You can go do a Google search right now on CFPB and alternative lending, and you'll see all of these. They talk about it. They want lenders to be considering all the other data sources that they could be leveraging. That's what's the beauty of Boost, is it combines the two of those things together. So consumer permission data to get you access to your utility payments, your TV and internet and other services, as well as even into streaming. So we're enabling that for consumers because we can't get the big utility players and the mobile carriers to actually provide that data to us directly. It'd be nice if the regulators stepped in and said, hey, you should also furnish that data directly to us, because that would be a lot easier. But we're making it happen. I don't think there's going to be any negative repercussions on that from a regulatory standpoint. In fact, we're driving financial inclusion, which I think aligns very much with the current administration's focus. And then on the AI ML, which is that third leg of it, the kind of advanced analytics, again, a lot of work has gone into doing this in a way that is explainable, that is clear to the financial institutions as well as regulators. The documentation is incredible. The ability to actually to create models and then automate the documentation that goes into the details of that. An example that we did with Experian Lift, which again leverages traditional data plus the extended FCRA data plus advanced analytics AI ML, we actually did a disparate impact study on that as well, leveraging the approaches that the CFPB recommended. We actually went to a third-party law firm to get it certified, that we did it all the right way. And that's actually now the first question we get from some of our largest clients of like, hey, I don't know if I can use this. I don't know if it's going to, meet the requirements. I'm like, look, we've already done all the heavy lifting. And most scores actually don't go through that kind of disparate impact study. And we found it actually had less disparate impact than any other score we could test it against. And so, that's the type of approach I think that is going to create more comfort in the industry, where you're, being very data transparent, you're being very clear about the uses of the data. And in many cases, we're only using positive data to create a more complete picture. So with Boost, we only show positive bill payment history because we actually don't know if you missed a payment or not, because we don't have the bill. Yeah. With RiskView 5.0, we only took positive public records data to add to that lift score. So again, where we can add positive data and create a more full picture of the consumer, again, I don't think that's going to run afoul of anything the regulators want. In fact, I think it's aligned with what they are driving for, which is driving financial inclusion.
Yeah, we agree. And I also, the interesting thing you mentioned that I think is often lost in these discussions is, you talk about disparate impact and shows, your lift and power scores were showing less disparate impact than any other score you tested. And I think that's often the thing we forget, is that the system as it has existed for however many years is not as inclusive as reality would have it be, where we to really perfectly understand risk. We would be more inclusive in our lending. And I think there's always fear about, will AI run afoul of fair lending? But I think we sometimes miss the opportunity for these techniques to actually improve dramatically financial inclusion, because the status quo isn't nearly where we'd like it to be. And I think that's the point that's easy to miss in this conversation, but so critical. And I think that your work, transparency is key with that highlight that, hey, we can make things, we can not only make you more accurate and not make things worse, we can make things better. For protected classes, for traditionally disadvantaged communities. And that's a pretty powerful statement.
Yeah, and the analytics are really clear. You can say yes to more people because of the analytics and the extended data sets you're using. And this is also something that's kind of hard to understand as well. Sometimes introducing negative data means that you can say yes to more people. So let's just walk through this for a second. Like if I have a population at a certain credit score where they have a 10% default, that means 9% of them won't default and 1 will. If I can bring a data source in that helps me identify the goods and the bads better, then the one that's going to default, I can find and say, no, this is not a good product for you. The other 9 I can say yes to. And so whenever I can merge both positive data sources as well as some negative data sources, you're actually in a better position to say yes to more people and reduce the risk of your portfolio. And some might say, well, you're saying you're bringing in more data just to knock people out of your lending product. That's not fair. I'm like, actually, no. It's about saying yes to 9 people by identifying the one where this product is not right for them.
That's right. Even I always use this example, but even like in a subprime, super risky portfolio to a bank, maybe it's 20% losses, which sounds really scary, but it means you're saying no to 8 good people because you couldn't find the 2 that were risk. Because
exactly
20%
right.
losses, 80% repayment. And so, in my mind, when we're operating in that kind of world, just any increase you can have in predictive power pays tremendous dividends because we're declining so many would-be good borrowers.
That's right.
Or overpricing them where we say, hey, we let you in, but just barely, and you're going to pay the maximum rate. We go, wow, we really understood the world better. We would put you in a very low risk category. And that's a burden that, frankly, not only the decline borrowers pay, but every approved borrower who pays anything over than the cost of funds for a financial institution is paying a premium because of our, as an industry, lack of understanding of risk. And it's a high premium for the American consumer, and it's something we can improve on.
I 100% agree. And look, if we want to even take smaller steps to start, like we don't want to reimagine the entire system from the starting point. I think every lender should consider this. Okay, you have your normal scoring model. First of all, benchmark it against, either Vantage or against Experian Lift. If I can score 96%, you can only score 82%. I feel pretty confident I'm going to do a better job. But secondly, maybe create a second chance opportunity. You have an application process, you're going to decline them. Just do a little bit of work, leverage a second score, and maybe you can say yes to them in a second chance. Or even better, a second chance plus, maybe you said yes to them, but to your point, I barely let you in the door and you're going to be at my top rate. Maybe if I have more information, I could do an improve your rate step where I use a new score or I use additional data like verification of income or employment. And the consumer goes through the extra burden of doing that because the promise is you're going to say no and now you can say yes. And so I have a lot of incentive to go through an extra step. Or you gave me this interest rate, but maybe you can improve it. As a consumer, I'm going to jump through a lot of hurdles to get a better price, especially if I'm buying a car or if I'm trying to get a personal line of credit because I want to remodel my home. A slight interest drop could be really material dollars, and not only are you driving financial inclusion, but even a better financial outcome for those who you are saying yes to.
Yeah, and the other thing I've seen for second looks that I think is really interesting is, the lenders we tend to work with, all over time, look at the population was just outside of their approval box and go, the stuff at the bottom of my approval box is doing really well, right? And these alternative scorings are like, they said they would be good, and like they turned out to be really good. And man, maybe I should and so there becomes for lenders, you don't have to jump in all the way to saying, hey, let's forget the old thing. Let's just do the new thing that don't play. But let's take the marginal. And as the marginal performs, you go, that becomes the normal. And you go, hey, let's take the next round of marginal and see if these alternative data sources, new scores can help us find the good 8 or 9 borrowers out of that population and bring them in. And I think my experience is lenders, they get there over time. It's a process to say, hey, we're watching it. It's getting good. It looks better. And it's great to start with something like a second look or a program or an extra consumer step to get into the program, because I think you'll find that to be a one-way road towards being more inclusive over time.
Yeah, and you talked about at some point now maybe in the future, if everyone's using these scores and you're not, then you're going to be actually at a big disadvantage. I don't think we're quite there yet, honestly, but I like that vision. But what I will say is I think the fintechs and the big tech players are more aggressive at looking at these types of data sources, these types of alternative scores like Lyft, like the Lyft attributes, like leveraging the Boost data that we have on the credit report. They're way more open-minded than I think a lot of traditional financial institutions, and so I think they are going to lead the way. And that point, it will change the benchmark, the baseline of what is good enough for your credit decisioning models. And I think the other thing that is an opportunity, whereas my largest financial institutions, they want all the granular pieces, the raw data or the data attributes of these alternative data sources, so they can build their own custom models, which we're totally down with, 100% supportive of that. But with something like Experian Lift, we can take that to a credit union or a regional bank who maybe doesn't have the resources to build their own credit models. And again, whatever they have in market right now, I would love to just show them we can beat their metric. We can beat them in a head-to-head, both on who they can say yes to and the risk they're putting onto their balance sheet. So, it's an easy win on that front. I think we're just at the starting line, frankly.
Yeah, I think it's a great point. You made it earlier, but highlighted here, which is as you get to higher accuracy and you're doing a comparison with a lift or a boost or a trend advantage or whatever the alternative scoring technique or approach may be, you have this really interesting dial that's like, do I want to keep my approvals where they're at and get more people, and lower my risk? Or do I want to keep my losses where they're at and increase my book? Or do I want to shift my loss? But you end up with much more control. It's not just bringing more risk into a book or more uncertainty. It's actually adding to certainty. And you can go, yeah, I want to reduce my risk. We can do that. I want to keep my risk the same and just double my population. You can do that too. And so it's a really interesting choice that they get to make when you really can think about how do I want to leverage that better predictive power to change my strategy in terms of approvals versus risk.
Yeah, and given the current environment, I actually start often with the financial inclusion as my first lead in of like, you can actually help serve the communities you serve today more, and you can do it with a better ROI. Now, a lot of them, they want to talk about their ROI and how do I make more money with this, but I think more and more financial inclusion is a driver, is a part of their strategy. And so if you can do both, I think that's really powerful.
Yeah, and the evidence is pretty clear. I mean, if you just look at distributions of credit scores among protected classes, it's clear that whenever you increase predictive power, you're going to disproportionately help people who have traditionally been left out of the financial system. And that means you're traditionally helping, disadvantaged communities of color, protected status individuals. So they tend to go hand in hand just because those are the populations that have historically not been well served by, the more traditional approaches. And so the increase in accuracy helps you serve those communities. That's a huge, not just a good thing to do for the world, good to do for business too, but it's the right thing to do. And I think it's a pretty powerful motivator for many bankers.
Yeah, interestingly, I think historically we've tried to not look at kind of race proxy flags or even understand like who's being served or who's being scored or who's not being scored because of fear of redlining or other things. In fact, I think I see a different trend now, which is we've actually built flags that can be used in an analytical environment to how you build your scores, leveraging the CFPB guidelines on how you do that. And more we're being asked, show me how my scores perform against different populations and different marginalized communities. Obviously, none of that data is in a production environment because then you do run the risk of redlining. But I think more and more people want to know how does this perform rather than kind of sweep it under the rug. And so I think we're just in a different environment. People want to know, they want to know how their scores are performing, how their underwriting is performing, and can they do a better job? And the answer is yes. Right now, the answer is yes to almost everybody. You can do a better job. And there's ways to do it, whether it's consumer permission data or alternative data assets that we can bring to bear or leveraging AI and ML or doing all three together in the best case.
Yeah, any combination of those I think is powerful. Although to your point, I think the AI ML analytics is almost required to take advantage in a real way of either the user permissioned or the extended FCRA kind of data sources. Because as soon as the data sources multiply and the data points multiply, then basic linear regressions and such are not gonna give you the power of what that data really has to offer until you can really combine them in interesting ways.
Yeah, the one comment I would just make, the fun part about Boost, the way we did that, which is a consumer engagement model, they add the data to the credit report. You don't have to do anything. As a lender, you automatically get the data. And it's part of your score, it's part of your model, it's part of FICO or Vantage. But I agree with you, as you extend beyond that, because there's a lot of other consumer permission data sources I'm interested in that I want to go after. We talked about some pretty basic ways to extend your data beyond the core credit report. We talked about trended data. We talked about alternative financial services bureaus. We also have another bureau called the Rent Bureau where we get rental trade lines. Those are kind of easy. I think there's a lot of data that goes beyond that we're looking at from a consumer permission model. One example, we have public records data that comes from RiskView from LexisNexis. And basically they're going out and collecting data that's publicly available on websites, including things like, are you a lawyer or an accountant or a plumber or a contractor? So these are public licenses that they can get access to. There's ways to do consumer permission data where you could actually go directly to a state and get every single license they have on file and let a consumer claim that they are an accountant or they are a contractor and then add that to their profile. Like, we're not quite there yet, but that kind of promise of, I bring all of my identity components to the credit decision that are relevant, because I can prove if I know you're an accountant or a lawyer or a plumber or a nurse or a hair salon, and you have a certification of that, you're a better credit risk, period. I mean, there's more data about you that we can make that credit decision on. So enabling consumers to kind of bring all of that to bear so they have a complete, full profile of who they are can only improve their credit decisioning, get better rates, get to a yes more often than a no, and for those who weren't even scorable, now to become scorable. And so that's the promise for me of going even beyond with consumer permission data.
That's really fascinating to get to those kind of sources of data. And if you can do it in a way that doesn't add too much friction to the lending process, or to your earlier point, if you can do it in a second look way where I'm
That's
only
right.
adding that friction in a would have been no scenario, so I'm not stopping the people where I already have good data. I think it's a really powerful model, and I think the technologies are only going to go to making that easier to do, right? Those are going to become more accessible data sources, easier to put into the process and take advantage of.
Yeah.
And that's something every lender should be thinking about.
And I've been working with consumer permission data for many, many years. Before Experian, I was at Intuit, where there's a lot of products that rely upon consumer permission data. The thing I've learned over all those years, if you have the right value proposition, consumers are happy to contribute more data. If you're just asking them to give data over, then they're going to be, more private, more like, what do you need this for? Why? But if there's very clear value on the other side of the table, getting to yes for an auto loan or a better rate for my mortgage, or being able to increase my FICO score instantly, those are value propositions people say yes to, and it's easy. And to your point, you don't want to put everybody through that flow, but through a second chance flow, again, you can get to a yes, or you can get to a better rate. And I think the consumer is more than happy to spend a little more time providing some more data to get to that answer, that outcome for them.
Excellent. And then I have one other question that I did not prep you for,
Okay.
but I've always been curious about, which is, one of the things I think Upstart in getting into the unsecured personal space, a kind of very different kind of loan than was traditionally given out by financial institutions, very different than what most credit scores were kind of targeted at predicting risk for. One of the things that strikes me is the absurdity, maybe is too strong a word, but the strange nature of using a singular score for products that are very different, right? Like I was saying, that just our range is like 5-year $1,000 loan or a 3-year $50,000 loan. Like you're not like a 7 something or a 6 something for both of those. You could be an 850 for one and a 500 for the other, because they're very different obligations. I'm curious your thoughts on that, or what you see people doing to adjust, because it feels like, well, obviously you could say, well, this is a riskier product, we're going to have a different, credit score requirement. It feels like there are people that, are in the middle that are really very good risks for certain products and very bad risks for other products. In a singular score doesn't differentiate between them well. And how do you see, if you've seen any trends on how lenders can or should think about that when they're introducing maybe new kinds of products that are not, well captured by traditional scoring approaches?
Yeah, great question. Look, I think consumers for many years were under the false perception that there's one credit score. And I think, more and more people are more aware that there are more than one credit
More than
score.
one.
And even with FICO, they have industry scores, they have different versions of their scores. So there is a somewhat of a proliferation, maybe even somewhat targeted versions of different scores. But honestly, they're not that well adopted. Some who are very narrow use those. So I think the opportunity, Jeff, is absolutely still there. I think we're again at a bit of an inflection point. We talked about AI and ML as a new technique to building better scoring models, leveraging broader data sets. We're also entering into a new world, and this is a bit of a buzzword, so I'm just going to throw it out there. ML ops and automation, right? So machine learning operations is a new approach, and we're on the forefront of that. Our Ascend data platform enables us to build new AI ML driven models in a much faster way. So even before Ascend, the data platform we had, if you go to traditional, like pull a data set, have a flat, file archive, and then you have your data scientists go crunch it for 3-4 months, and then it's ready for doing analytics, and then they're going to build analytics for 3 or 4 months, and then they're going to go through governance and QA testing and documentation for another 3, 4, 5 months, and then maybe 18 months later you have a new score. With Ascend data platform, we've crunched the middle part of that to near real time. I mean, you can be building AI ML models in hours and days rather than months to years. We're also now automating the kind of data wrangling, the what data do you need, how do you pull the data together so that you can actually build the attributes that then allow you to build the analytics you want to go do. And on the back end, we're crunching that side of it through automation as well. So automated governance, automated deployment, automated documentation generation. And so you can think about going from building a new model in kind of 9 to 18 months to days or weeks. And again, we built Lift. It took me 18 months to build Lift, from the data scientists working on it to getting it into the credit report channels to getting into batch environments to getting into real-time environments. 18 months. And we probably, as a credit bureau, create 2 or 3 new AI ML models at a production level, at a product level every year. I have the promise of being able to do 20, 30, 40 of those a year. And we do maybe 20 custom models for clients every year. We could do hundreds of them in a year based on the new technology that we're leveraging. And this is, there's other companies out there, you probably could name them if you wanted to, who are doing automated AI ML capabilities. But as a credit bureau, we need to be on the forefront of that, enabling our clients so that if you're a credit union and you want to adopt a new model, you can do it in a matter of days or weeks. In fact, I may even walk into your door with a new model that you can benchmark against that I pre-built for you. And so that's the kind of promise of the new world we're entering. And, I have Lyft, I have Experian Lyft. I plan to have 2, 3, 4, 5, 6 versions of that in a year and kind of micro-segment them down to subprime auto, and how about prime mortgage, and how about, fintech, personal lending, and how about buy now, pay later scores. I think we're entering a world where you do want to do that because different data sources will actually perform better in different environments. And also the consumer experience, you have to worry about of what data source are you bringing in, and does that require consumer engagement or not? Well, on a mortgage, maybe that's fine. On a $500 personal lending loan, absolutely not. So I think we're going to enter in a world where there's a lot of flexibility on that front, and the scoring will not be a bottleneck like it is today, the score development.
Score development. I think it's a really interesting point. And the thing that strikes me about all of the trends you've mentioned, from user permission data to extended FCRA data to the enhanced analytics through ML and AI, to things like ML ops, is they're all like turning the same way in a flywheel. They're all feed on each other and enable them. It's like, well, ML AI is great, but it takes 18 months. Well, actually the technology is coming where it'll take 18 days instead of 18 months. And well, all this data is great, but I can't take advantage of it. Well, the techniques are here now to take advantage of it and to do it quickly. And so I think as these things all come together, I think that's why at least I'm so excited about the space, is it just feels like all the pieces are coming into place where there's a dramatically different and better way to approach this question. And now finally, all these trends come together to make it really possible, not just in theory, but in practice, and for financial institutions to really be doing this in the very near term, which makes it, I think, a really exciting time to be in this space.
It is, and I wouldn't even say in the near term. If you are thinking about how you did credit decisioning the last 5 years, you're going to miss out in the next 5. And you're going to miss out both from serving your communities through driving financial inclusion. You're going to miss out by saying no to people you should have been saying yes to. You're going to miss out on money on the table. And so, and it's not sometime in the future when the regulators say it's okay. The answer is it's right now, right in front of us. We have the solutions, we have the data, we have the attributes, we have the scores. And so the answer is go now. And we're not going to be slowing down. This is going to be speeding up, and the benefit is going to accrue to the entire economy and to our consumers as well as our financial institutions. And I agree, it's a super exciting time.
Excellent. Well, it seems like a pretty good place to end the conversation. Both of us excited. I do have 3 questions I ask all my guests at the end, so I'll kind of rapid fire. So I'll fire them to you now, and then I'll say goodbye. But the questions are: number 1, what's the best piece of career advice you've ever gotten?
I think the best piece of career advice I've ever gotten is there are no rules to your career. I was actually talking to an executive coach at one point, and I was like, I don't know, it's either go do this next thing or maybe go and do a startup. But I think if I take a couple more years, that won't even be an option anymore. And he paused, he's like, don't create false rules around your career. You can go do whatever you want, whenever you want, as long as you understand what your goals are and what values and beliefs you bring. You can go decide to do whatever you want with your career at any point.
No rules around your career. I like that. Is a very unique piece of advice, but I really like that. All right, my second question. What's the best piece of advice you've gotten about the consumer lending space?
Consumer lending space, best piece of advice. I think it might have been advice I gave myself, which is you don't have to do it the way it's always been done. When we were building Boost, there was a lot of times where I felt like we ended up at a dead end. This wasn't going to work. It was too hard. The analytics weren't making sense. How do we get consumer permission data through compliance and the regulatory process? And multiple times I had to sit down with the team and just say, look, we got to find a way through this. Positive bill payment history has got to be good for consumers and good for lenders. There's got to be a way through, and that's what innovation is all about: is being resilient and knowing your strategy and your vision and sticking to it and finding a way through.
You don't have to do it the way it's always been done. That is so true. And I think sometimes the people with the most experience have the hardest time seeing that. They're the people who know so ingrained how it's always been done that sometimes you can't see the forest for the trees the way you've always seen it done. My last question is, what is one bold prediction for the future? So I can drag you back here in a year and tell you were right or tell you were wrong, and we can compare notes.
Okay, a question I get a lot is buy now, pay later for real? Is it just...
I like the
Is it just a layaway program with new lipstick, or is it a change in consumer behavior? My prediction, and it's not a really hard one, but I've heard people say the counter. It is a new consumer behavior. It is a new shopping experience. It's here to stay. It's going to grow. It's going to grow a lot. And if you think it's
What's
just
the
something
nature of the new experience, like what do you think is the new part that is here to stick? Because I've heard a couple different takes on what makes this very different than a layaway or a credit card. I mean, in some ways, if I paid in a credit card and paid it off in 3 months, like it's very similar, maybe a little bit higher cost than a credit card. But like, what do you think are the parts that are really new and sticky about the buy now, pay later space?
Well, there's a couple that are very obvious to the consumer, and then there's a couple that are behind the scenes, I'd say. To the consumer, it's in checkout, it's super simple. I can apply and get it in the same time, and it's being used to pay off not some future credit that I'm going to maybe use tomorrow, but just the thing I'm buying right now. And so it's very controllable and understandable, and I'm going to make 4 payments and very clear like what I'm signing up for. And so It doesn't feel scary. And I think a lot of people who've been burned by credit in the past or their own behavior using credit or personal loans, this is very contained, if you will. And I think it's easy, it's simple, and it's clear of what you're signing up for. I think behind the scenes, some of the differences is the way they're paid. They're not paid by people making payments late or by having interest rate fees to the consumer. It's all through merchant fees. And then so they're kind of paying for their losses through the merchant fees. The merchants have benefit because they have a higher conversion rate and they're selling more per basket, and that's more than offsets the losses the buy now pay laters are seeing. So it's kind of a win-win that happens behind the scenes that doesn't even impact the consumers. And so they have a ongoing benefit to make their consumers happy without having to rely on them for fees. And I think there's a lot of pieces to all of that consumer experience and the merchant experience and the lending experience that are positive, that is a bit of a positive flywheel that I think will go well. There may be cases where people use it irresponsibly. They get too ahead of themselves on too many buy now pay later loans, and that'll happen with any credit product, and so that doesn't scare me. I don't think that's like, oh my god, this is just a negative spiral we're sending consumers off into. In fact, of any lending products I've seen recently launched, this one's very clear and very controllable by the consumer, so I'm actually pretty bullish.
All right, bullish on buy now, pay later. You just got to get the buy now, pay later into one of your extended FCRA or user permission data sets. So
stay tuned on that.
Like I said, but yeah, I will keep my eyes peeled for that. And thanks for a great conversation, Greg. This was a lot of fun, and I appreciate your joining.
Yeah, thanks, Jeff. That was great.